in really good detail so everybody understands it. And you see that E-mini trade. We had a lot of opportunities today to be stocked out by the E-mini, and we avoided all of them. And again, I don't want to be a broken record, but you know, I had to step away for 2 minutes, and it cost us this really nice entry, and would have pushed us from 270 to 300. What I want to do is I want to go over the transition zone trade really carefully so that everybody understands it and sees how powerful it is. Now, it's totally a discretionary trade, so you have to decide, you have to make a decision how you want to take it. But the thing about the transition zone is there's certain criteria you have to have. One is the background bias has to change from any color to green. And you must have the quant line. You must have the 50 green, and you must have the 15 green. So those are the three things you must have. You must have the quant. You see, here's a potential, this is an aggressive transition zone entry right here. But the modified 15 is yellow and the quant line is yellow. So you have no entry, even though this worked. Without the quant and without the modified 15 above the 50 in green, it's a much, much riskier trade. Now you can take this trade right here. You just count the candles. It's 1, 2, 3, 4, 5, 6. This is the 7th candle. So this entry is just a C candle entry to the upside. Nothing more than that. You want to take a transition zone trade when the MA diff is tight, and I can't give you an exact number, but you want it to be about 7 max. Because if you're looking for a huge move to the upside, like this, and you're not going to get it if you're entering the trade up here. It's much less likely. Now, on this transition zone, you have no entry. You want the zone, you want the modified 15 red, you want the 50 red, and you want a quick retracement. Now, here is a transition zone trade. This is a doji. It's got no candle body. So you have the move up, you have the move back. Now, what you can give a little bit away, a little bit is on the distance from the 15 to the 50. It's such a powerful move. Our max, we want 4 ticks or less. If this is 5 on this trade, and it's a 7 ticks of buying pressure, this is an entry. Now, it's going to take you up to the top. Now, I want to go over the ATM with you, so you see exactly how much money you make at each step. It goes 21 ticks. And I also want to review the exit criteria. Now, you start with 2 contracts. Now, your first target is 7 ticks. Now, the stop is at minus 10 ticks. It does not move. So you're still at risk on the trade if it comes straight back at you to lose $30. But the only way we're going to get 30 and 40 tick moves is to take a little bit more risk. Now, when the trade hits plus 10, the stop goes to minus 5 ticks. Now, your 15 ticks separation. You're plus 10. You've locked in $50. You've locked in $70. So with the stop at minus 5, if you get to plus 10, and the trade comes right back against you, you're going to make 20 bucks. That's it. but you're on a trailer now. You're on a 15-tick trailer. So every time the trade goes an additional tick above 10, you lock in an additional tick of profit. So at plus 10 ticks, you're on a 15-tick trailer. Now it's a very aggressive ATM. That's why you have to get in. But what we're trying to do is to get in at the start of a trend that occurs right near the 50 and is close to the 15, so that we don't have to worry about the trade coming back to support and stopping us out. And you can give it a little bit, because when you get a retracement very early in the transition zone, it's usually a very nice trade. I went over 1 million of these, and you very rarely get a loser. Now remember, the exit is going to be the maximum you're going to take is a pullback 15. This is the top. This one went back 17. So this is going to stop you out. So your profit on this trade is going to be very small. You're going to lock in 4 and 7. So you're going to make $111 on this trade. That's it. Because it made this move up, and now the other exit is if you're moving up and up and up, and the modified 15 turns yellow. When the down candle that turns the modified 15 yellow closes, you're out on a down close. And that can save you a lot of money, because you're only going to lose 8 instead of 15. And of course, if you're moving to the upside and you hit any upside resistance, you can always close the trade. If you've locked in 30 or 40 ticks of profit, which is a $470 trade or $370 trade, you can always close it. But that's the parameters for the trade. And let's take a look at a few of them. And I'll go over any questions. Now, here's a transition zone to pink. We really should look at them during a trading session, because it's the only time we're going to get any volume. See, here's a transition zone. See where you are? The trade's already way up here. You have no retracement, and you have no entry. Now, here's a transition zone. You're already all the way over here. It's 1, 2, 3, 4. It's 5 candles. You want a very quick retracement and a move down. And actually, that's a 5-tick trade. On a traditional move down out of consolidation, it just would have hit the first target. Again, no retracement. Straight down. Nothing. Here, you're just that MA diff is too big. Here, there's just no trade. There's no retracement. Same thing here, no retracement. Now, here's your trade. The retracement occurs, you actually get price falling, and the background bias turns green. That's usually a very, very good sign. And this trade is going to go $16. So it's not going to make you much money. If the modified 15 stays green, there's no reason. Well, you know what? It may not even stop out. What I think is it goes all the way up to here. I don't see 15 ticks of pullback here, actually, on this trailer. I think you're going to go all the way to here. Now, on this down candle, I don't know if the modified 15 changes color or not. Let's suppose it doesn't. So you're going to get 6 ticks on the runner. You're going to make $130 on the trade. Now here's what we're looking for, right here. There's the retracement and a C candle and the development of green background bias. And you have the quant. And this is going to take you now. I don't know. Let me see if this stops us out. Yeah, it just stops us out. So the trade's going to go from the entry here to the stop out here. That's 9 ticks. So that's 90 and 70. So that's a $160 trade on 2 contracts. And here's another one. A pullback right at the point of the transition zone. There's the entry. Now here we only have 1 candle pullbacks, so it can't be a 15-tick pullback. So it goes 48 ticks, subtract 15, and you've got 33. So you got, this is a $400 trade, 33 on the runner, and you've got 7 locked in at your first target. So you make $400 on this trade, and this would have come in at 9:04 in the morning, 9:03. It's a gorgeous trade, and that's what we're looking for. Here's a transition zone. You know, it doesn't pan out. Now on this transition zone here, it doesn't turn green till here. Doesn't work. No retracement here on this transition zone. This is really far off, and the modified 15 is yellow anyway. Now we're only looking for it on crude. And here again, here's your perfect. Right here, the chart turns green on the retracement because you move up and you move back, and on the continuation up, all your higher time frames come into sync. You've got the quant. Now let's see if this stops out here. It misses it by a tick. It comes back 14. So you're in this trade all the way to here. That's a 61 tick trade. Subtract 15, you have 46 ticks. And so you have a $460 trade there, and you have the 7 you locked in. That's a $530 trade if you just let it run. And you'll notice we just haven't had a loser. Now, the problem with this trade right here is the MA diff is really big. Remember, we want them tight. It's 17. It's actually on the edge of being overbought. So we're not going to, there's no transition zones when the MA diff is this high. We're looking for the MA diff to be really tight to the 15. And this is just a traditional move out of consolidation. It's not a transition zone trade. Now here the 50 is red, you have no trade. Here the modified 15 is yellow, you have no trade. No trade here on this move up. Here's your transition zone trade right here. Turns green. And what I think it's going to do is I think it might stop you right out. This may be the first loser we find. It ticks you in, and I think that it's going to come back. Let's see if it comes back. Yep, it comes back and stops you out. But you're right back in here. Or if you want to be a little more conservative, you're in here. This is only the second candle of the second transition zone. Now, I would be hard pressed to take a long here on the small candle body, but on this big candle body, I would chase this trade because of the nature of the trade. We can give it a little bit more. Now let's see if it goes to here. It goes 14, and then let's see if it comes back and stops us right out. Comes back just 15. So on this trade, we'd make just a little bit of money. Very little bit, very small. Unfortunately, we'd miss this huge move up just because we got two candle. We got this just one tick by one tick. But we didn't lose money here. We would have made about $100 on the trade. This is just a traditional trade that we would take short on 4 contracts. Now this is the kind of trade, this is another traditional trade. I mean, it's a consolidation move and a move to the downside. This is just a retracement and a move up. We don't get a transition zone trade here at all. Here is just a move down, retracement, and continuation. Same thing here. Short at a consolidation. This is way too far off to take this as a trade. I mean, you can give it one tick, but you can't give it a whole candle. And the distance from the candle open is 9, and this is a yellow modified 15. No trade here. No trade. It's too many candles. Now, if you wanted to take this trade, you could. It's a little bit risky because the candle body is so high off the. I mean, you can go 5, but this is 8 ticks, and you would make money on this trade, but you wouldn't make much. And what we're really doing is we're trying to, on the trades that don't really go, we're trying to make it so that out of all those trades I showed you, only one trade was a loser. All the other trades made either a small amount of money, one made 400 plus, one made 500 plus. So as long as they don't take money out of your pocket and the risk is small and the potential reward is huge, that's the kind of trade we're looking for. Now, I can't give you the exact number of candles after the transition, but once you start building 2, 3, 4, and 5 candles and you get a pullback, you're probably just going to get a traditional C candle. You're not going to get a transition zone trade. You're looking for a quick pullback after the zone changes to green and tells you that all upside resistance is broken, and all the higher time frames are now moving to the upside. The chance that this is going to move to the upside is extremely small, extremely huge, if the MA diff is relatively small. Now here it's 24. I didn't know it was that big. That's a very, very risky transition zone. You start to lose your perspective a little bit unless you check it on every single trade. You want them to be tight. So that's really the nature of the trade. You want to take a low-risk, high-reward trade. And these are the best. Let me just get all of the other scaling I have on here. And you see this a few times a week, is when you actually get the transition zone color to change on a retracement candle. Now you can take this as and move out of consolidation. There's nothing wrong with that, because it is. And you have the quant, you have background bias, you have the 15 cross the 50 to the upside. The 50 and the 15 are both green. And there's no reason why you can't do that. So it's really up to you, but I think the better way to take the trade is to take it on a transition zone trade. Now, we already scaled it, and we know that in this particular case, taking the trade on a traditional basis would have made us, and you know, it wouldn't have made us more money. Would it come up? Well, it just would have come 10, and that would have locked in $250. So in this case, it would have made us more money than taking the transition zone. But let me see how far back. I can't remember if this is the one that came back 14 or 15. See, this one came back 14. So this didn't stop out. So this transition zone trade would have gone all the way to here. And if I remember, this was the 61 tick trade. That instead of making 250, this would have made us over $600. So that's really the nature of it. I'll go check for questions in a minute, and I'm going to call them in the room, because we have to switch our ATM. If you look here on crude, we've got now this CL1 is 2 contracts. This is 4 contracts, and here is the TN, transition zone, which is 2 contracts configured in the way that I had told you. Now let's just take a quick look at where the market is, and I want to go over the actual trades I took on crude. Because what I've found is taking counter trend trades is very, very, very difficult. And they're very treacherous trades. These are our bread and butter trades. I'm sorry I didn't bail. I bailed on this. I very rarely do. But this trade I did not think this was going to have any legs, because it didn't have any volume. I could not see into the future and see that volume was going to come in after we exited. So I closed. We got 4 ticks. We made $40. And then here's what we're really looking for on a short trade. It's got to be a double top like this. And this is another top. But you want to see that the second time the bulls try to push price up, they can't push it up quite as high. So what you get is you get a falling channel off of a double top. These are lower risk trades. They're still more risky than a trend trade, which is why we only take them with 2 contracts and not with 4. Calling a reversal can be tough. This one created a pivot, and then we had the opportunity. You'll notice right here, this was a rising channel. Price made a higher high, and it did fall. But so what? That doesn't conform to our criteria, and we're not taking those trades. Even if it's 1 tick, then I had to leave for 5 minutes, and we got the exact same trade we took before. Bulls were weaker. They couldn't push the price up as high. We got a falling channel and a 14-tick short. And I would have absolutely taken that trade. This is a much tougher trade to take, but I would have taken it if there wasn't a pivot. I'm not going to trade into this pivot. And really, it was consolidation, and it's a form of a trend trade, because now we're trading into the trend. We know that we want crude to break to the upside, and consolidation is almost always going to break in the direction of the trend if the market is not overbought. And here it was not overbought. The MA diff was 15, and acceptable is up to an MA diff of 18. We're not looking for a reversal here. This isn't a double top and a falling channel. This is consolidation. And what makes consolidation so powerful is you've got traders trapped in both directions. You've got short traders, a lot of short traders trapped here, a lot of short traders trapped here, and then you've got all the traders in these long candles. And up until this trade moves to the upside and breaks the pivot, you just don't know. These short traders are praying for a pullback to the 50, and these long trade as a counter trend trade out of consolidation right into support. We wouldn't entertain that trade. We're looking to trade into the trend out of consolidation when the MA diff is this small. Now, if we didn't have that upside pivot, this would have been a perfect trade. The upside pivot added too much risk for me. So I'm not looking back on this trade and saying we should be in it. I'm looking back on this trade and saying, well, why I didn't take it. Now, it went 25, it just as easily could have hit the upper pivot and come right back in our faces and stopped us out. So we don't know what's going to happen when we're on the right edge. So that's always a pretty scary place to be. And you got to be ultra conservative on that right edge. But this was an absolute trade for 14. And now if we look what's going on with crude, it's slowly melting into the woodwork. We've got no movement on it at all, which is why what I want to do is come back. If you look at the E-mini, we can't take a transition zone here. There isn't enough volatility in the E-mini right now, and you can see what happens. This is a chase dot. It's signaled here, and potentially you could have just gone short right here, and to see where, see, it was below all support. But what I would look for is a break and a retest, because they're a lot more conservative. Another chase dot. This comes, though, without any quant verification at all. Now, unfortunately, because we closed and opened the NinjaTrader, the only thing that's absolutely real is what we're seeing from today. It shifts everything over by one candle because of the way that the platform is coded when you have a fractal indicator. So because we have the chase dot will not appear unless the quant lines are with you. So my supposition is that in real time, this was over one more candle. And this was over one more candle. And when we closed it and reopened it, the NinjaTrader code shifts everything to the right. Because what happens in real time is it compares what's going on with the previous candle with your candle. What happens after you close and open is the code shifts it so that it compares what's going on in your candle with the future candle, which hasn't formed yet in real time. So now it's making a comparison here. In real time, it's making the comparison here. So it's going to shift everything back by one candle. So you have to be really careful when you do a look back and you see an entry on a chase dot. You know that you're going to get the quant lines. But chase stock trades are very are scary. Now, this was this week, and this was yesterday. This was just on the right edge. The move down, this was, I'm sorry, Tuesday. The move up, and you see the triple quants. That's really what I want. And it's the trend trades that are bread and butter trades. And then we had the following channel off the 50. And we took this out just at the right time. It went another couple of ticks. But if we would have closed on a retracement, we would have given them back and then some. And we had 4 trades and 4 winners in 357. Today we have 2 trades and 2 winners, and we have 157. And it's just bad luck that I had to step away and miss that other winner. That would have given us at least another 100 to give us 257. Now, I'm just trying to think what else we can go over. We have another 15 minutes, and then I'll look and see if there are any questions. Just the multi-time frame analysis and the quant lines make a trend trade extremely conservative if you wait for the alignment. And that's what we're going to do. I mean, unfortunately, I bailed. It went 21. We got a reversal at 13, but it's got to meet very strict criteria. And then we got that same reversal again, as I mentioned, right here. Let me just see what happened on Tuesday on crude. I don't think we had any trades on Tuesday on crude. I think both trades, we did have. See, they're all the way down here. For some reason, I don't know why this shifted. Oh, I know why. We changed the contract date. So it shifted all of the, it shifted the entries. That's what happened. So I can't tell you exactly where we. This was the day we had the trouble on Monday, where I went with counter trend trading way too much, and we had some really nice good trend trades here. And that's when I did, a really intensive review and what we're really going to. And here was a transition zone right here. Everybody was yelling at me in the office, but we didn't have the ATM set up and sent out to you. I saw the transition zone, but I couldn't take it because nobody had an ATM for it. And if I did, we would have gotten a 48-tick trade. We only have 47, but and that would have locked in for us 7. And it would have locked in 32 or 30 or 33, whatever. It would have been a $400 trade, and that would have been the end of our trading for the whole day. I would have made $400 on 2 contracts. Actually, I'm sorry. I'm taking the high here. We got to subtract. Yeah, that's correct. We subtract 33 from that, and we get. That's 35, 34, and that's 34 ticks, and the first target's 7. That's a $410 trade, and I saw it, and I just couldn't take it, and that's a perfect transition zone that I just could not take. And the dilemma is whether or not a pivot will break or not is just. The only time I'm going to anticipate a pivot break is when we move out of consolidation, which is a very powerful move because you have a whole bunch of traders trapped short and a whole bunch of traders trapped long. And when the trade snaps, it's going to move with a lot of force, and we're going to anticipate a break of a pivot on those trades, and maybe on a C candle. I think it's very tough to take a now the C candle does what consolidation does. It's just trapping one group of traders in that counter trend position, and that's what we always look to do. Now here was a trade at 10:30 that I must really have been asleep at the switch, because this is a move out of consolidation and a perfect long trade. And I don't know that he didn't take it. I just don't remember taking it. And that would have gone 14 ticks, would have locked in 250, and then run. So I think we would have made 290 on that trade. On the 4 ticks, it pushed up our stop as the trade trailed. I mean, that's a shame I didn't see that. But the system gives us tremendous signals. And the best way to go always is to take a trend trade. Use that background bias and leverage it. Unfortunately, let's take a look at the day that I wasn't here. I could not be here. And that was yesterday. That was the 17th. Let's take a look at trading on the 17th. Now here there was nothing. That's a very, very risky short. And I believe if you took it, though, you would have made a first target. Now here's a nice short. Retracement and continuation. Just let me see where the value area low was here. So you had room. You just had to worry about that low pivot. And I think you have room for that pivot for 5 ticks. So that's a nice trade to the downside. And then we had nothing. And here's crude inventory. So we could have had one winner here, and this is a 2-target winner. And let's just wait till it starts going to 1031, 1032. So now the market slowed down. You can see this continuation long into the value area high went nowhere. That's always the concern. It's right into it. You would have gotten stopped out. And here's the transition zone, right here. Now the value area high here is all the way up here. It jumps, but there's your transition zone entry yesterday. And this, I think this is 5 ticks. Yeah, it's 5. This is where you can give it one more tick. And you don't have the value area high on the entry. It's way up here. So you're in the trade. And this is a nice trade. It went 21 ticks. You give back 15. You have 7 and 7. Have a $140 trade on 2 contracts. Very, very conservative. Now, there's your first falling channel right here. And you get this move to the downside. It's going to bounce and stop you out, but not before you get 2 targets. This trade you can't take. It's just a bounce off of a pivot. You need it to bounce again, and it's got to be in a down channel. This is a higher, price is higher, so the channel is rising. Here, price is lower. The channel's falling. And you take the short right here. Now, this is just very risky without background bias, and I would have passed it up, I think. It's a move out of consolidation, which is a powerful move. You've got the 50 and the 15 down, and you got the quant. We can just pass that trade up. But now we're going into the end of the day. We're at 2 o'clock, but there's a transition zone with a pullback right into the start of the zone. Now, you have the problem with the value area high, but you're pushed through it. This wouldn't have made you a ton of money. But this would have been very profitable, actually. There's your perfect. Of course, that's in the middle of the night today. So that's really just a brief overview. I want you to understand the transitions. They're very, very powerful when we get them. We just have to wait for them. We didn't have any today, and believe me, I was waiting for them because I wanted to jump on one and look for a nice runner, but we just didn't see one. So we couldn't grab it if it's not there. Now, the algorithmic system took three awesome entries, and I'm really surprised that the trade didn't work on bonds. It was a perfect trade, and at the same time, I watched the ES push higher and higher and higher, and was waiting for bonds to collapse, and bonds also pushed higher, which is very unusual. The price pushed against dual quants, and it happens, but it was a perfect setup. It's a perfect setup. And the system closed on an up close, and it still gave you a tick of slippage and gave us a maximal loss on the trade. So let me see if there are any questions. Because what we'll do is we'll take a half an hour break, and then we'll come back. We're going to come back at 1:15. If you want to trade the afternoon. All I'm going to do is look for one two-target trade to push the room equity from 170. And if we can get 250 on the trade, we'll be up 330. So I'm just looking for one really, really nice two-target trade, or maybe we'll get a trade on the E-mini. We'll see how it works. Usually into the mid-afternoon, the E-mini is not so great, but into the close of the pit, we may be able to get a trade. And if crude is dead, we're just not going to chase it. I mean, we'll take what the market will give us, and the name of the game is to preserve our capital and not take losers. And that's the thing we avoided Tuesday, and the thing we avoided today. We avoided all the risk associated with trading the E-mini, and it really worked out great for us. Didn't take this long trade. I mean, I was concerned. It only had one quant. It didn't have any upside resistance, and look, it just collapsed. We didn't extend ourselves at all. We waited for the market to come to us. We waited for at least dual quants to take a trade on the E-mini. We didn't get it. I mean, we almost never got an alignment. Here's where we got dual quant alignment, but boy, this is a real tough trade to see. With the 15 just moving across to the upside. It's there, and it's an entry, but it's awfully rugged. And this is not a piercing candle either. But it's a tradable entry. Just very, very tough trade to see. I did not see it. Now, if I go back and look at it, I might reevaluate it, but it's really a tough trade. I don't know if I would have taken it. So we're going to come back and take a peek. Let me just see if there are any questions. What I want to try to do tomorrow is finish the week out perfect Wednesday, Thursday, and Friday. I want to avoid all losers, and that's really what makes you successful. If you minimize risk, trade with specificity, don't take a losing trade, and don't ever go to the bathroom, because that's exactly when you're going to, excuse my French, but that's exactly when a trade is going to come and give you 14 ticks. You'll wind up making nice money. So hang on one second, just let me see if there are any questions. Alan, you don't have to roll the NDT. All you got to do is roll the contract month on the chart. That's all you got to do. On the algorithmic, we will reset the contract date tonight, or actually right after we close the room. So tomorrow, the algorithmic will be trading the front month. Matt made $687 today. Here's the thing, Mark. When you take a reversal trade, you're always going to take those trades against the background, against everything. And that's why they're riskier trades. And that's why I want to minimize the number of reversal trades I take. But if you take them with a tremendous amount of specificity, a falling channel, and the other thing that's important for you to see is you see this sell candle has 8 ticks of sell power in it. If this candle had 4 ticks or 5 ticks of selling pressure in it, I wouldn't have taken the trade. But it engulfs this candle. And you can see that the sellers here are really in force. Now it's a counter trend trade. So it's going to be against background bias. It's going to be against the quant. It's going to be against everything. That's why I took it out just as it hit support. Or maybe it was just a little bit below support. I don't remember exactly. But we took it out at a great spot because my anticipation was it was going to turn. Sometimes these go all the way to the 50 and then turn back up. But they are definitely riskier. And they're not my cup of tea. But you're not going to trade these with the indicator. You don't get indicator confirmation here. This is the other one where I just wasn't in front of the chart. I had to step away for 14. And this is why this trade to the upside at a consolidation was only stopped by the pivot. My taking it because this was a trend trade. It was a break of consolidation to the upside. We had the green quant and we had green background bias. All we had to do was anticipate a break of that upside pivot, but I couldn't do that. And I didn't want to run the risk of trading into the pivot and it bouncing back at us and giving us a $200 loss. It looks great after the fact. But on the right edge, I saw the trade, and I also saw this too, that if you took the trade, well, if you took the trade here, you got stopped out here. And the fact that the bulls got a little more power here, the bears couldn't push the candle as far down. Channels rising, and you have everything. Those are the trend trades you want to take. You just can't have upside resistance, or you run the risk of getting banged. So I stood aside on that, and that was an appropriate thing to do. Just because the trade won doesn't make it a great trade to enter. And I think this is way too risky. But the counter trends, you're going to see, it's against, you don't get indicator confirmation. It's against the color of your indicators. But as long as you take that falling channel, you have a really good shot at getting a first target. And maybe you'll get a runner all the way to the 50. The only other counter trend trade we do is when price comes down, comes back up, and then continues to the downside on a C candle. That C candle tells you it's an engulfing candle, and the shorts here are really selling the market with tremendous enthusiasm. That's it. I want at least 80% of our trades to be in the direction of the trend, because they're the safest trades, and they're the ones that usually yield us the most money. That's what we're looking for in every trade. Okay, I think I explained that to you, Mark. So you'll see that. Okay, Matthew. Matthew was trading the wrong month. Okay, Gail. The MA diff is simply this. The MA diff is the distance between. Now, we looked at oscillators for calling overbought, oversold markets. And what we found is that an oscillator has absolutely no predictive value in increasing the precision of your trade. They're useless. It doesn't matter whether it's a stochastic, whether it's a CCI, whether it's relative strength. They just don't work. So the key to, we did 2 years of market replay data until we were blue in the face, and what we found was, as the distance between the 50 and the modified 15 begins to increase, that's when the probability of getting a successful trade begins to fall. So the MA diff is simply short for moving average diff in ticks. So when the space between the 15 and the 50 is 18 or less, 18 ticks or less on an 8 range, 13 ticks or less on a 5 range, you're not overbought and you're not oversold. But when it gets over 18, the risk associated with the trade starts to accrue. Now, if the MA diff is 18 and you see a perfect setup with an MA diff at 20, you can still take the trade. You just have to understand that the trade is associated with a little bit more risk. The goal of the platform is to define risk. And if the MA diff is 20 on a perfect setup, you can take the trade. Just realize it may be a trade you want to take with 2 contracts instead of 4 because you have more risk associated with it. So that's what the MA diff is. It's a true indicator of an overbought, oversold market. On a 3 range, the MA diff you want to be 8. And we have the MA diff set on all the time, all the tick, all the different time frames that you may want to trade. But these are the ones for the for range, and they're very, very accurate. And I really look to trade with an MA diff of 20 or less on crude, and I like to stick with that 13 on the E-mini because the E-mini is very rugged, and that's what we're going to, that is the is what we found running multiple analysis on 2 years of market replay, 13 on the on a 5 range on the E-mini, and 8 and 18 on an 8 range on crude. It's also 18 on gold. It's 18 on the NASDAQ. Stay within those parameters. And here's another thing that I rarely mention, but I think it's worth pointing out too. Let's say you get this move on huge volume that's really fast, and the modified 15 doesn't have time to catch up to price, and that happens sometimes. So what we did was, let me make sure it's set right. Every now and then I see it and it's not. What we did was we set a safe zone. This is on the right edge. This is always 18 ticks below the 50. And on the right edge, this is always 18 ticks above the 50. So here's the sweet spot for trading. You're not overbought and not oversold. Right here. 36 ticks, 18 above and 18 below. Or if you want to push it a little bit, it's 40 ticks, 20 above, 20 below. And that's what the MA diff is going to define. Now, usually price hugs the MA diff fairly closely, but once in a while it just shoots on an institutional move, and it could be 25 or 30 ticks above above the 50, but the modified 15 just hasn't caught it yet. Then you just move to the safe zone. It forms on every single candle. It's always on the right edge because it's the only place you really need to look at it. And if we put it all the way across, it would be really a nuisance to watch because it would be a line that have no relevance going out that far. So I hope that answers everybody's questions and they understand our trading methodology. Our core system at 80% of our trades are going to be in the direction of the trend. If I see a really advantageous counter trend trade, it will be against the indicators, but what we're really looking to do, and the transition zone is another way to leverage the trend, is to get in at the beginning of a multi-time frame alignment. And the rationale is the only thing that can align multiple time frames in your direction are the institutions. It's institutional money. So when you see the time frames align, you know that the institutions are participating, and you usually get a nice move up. Now sometimes it's just commercial traders, and that's why we can't chase it high. But this is a great trade, and they recur over and over here. They recur over and over and over again, and rarely are you not going to get 7 ticks on the trade to cover, to leave you only at risk for 30 bucks. If that's all you lose on the trade with a potential upside of $400, $500, and $600, your risk is very small to make a large amount of money. And remember, we are not going to touch these trades unless they come back and stop us out, or the modified 15 turns yellow, or we hit an area of major upside resistance or downside support. Then it's discretionary as to whether or not you want to close the trade. There's no way of knowing whether it's going to break. If it comes back and bounces, you give back 15. If you take it off in an area of major support or major resistance and you lock in, you may lock in $250 or $300. That's something that we'll have to look at as the trades mature. I mean, we should be so lucky as to be up 25 or 30 ticks. We've got 7 locked in. And if we hit an area of major support or resistance, we're probably going to close the trade. We'll take our $350 and $400 or $400, and we'll look for another trade. I mean, I think the best way to do it is to be conservative. That's what I was trying to be on that first trade. I just didn't see it maturing on no volume. Then as soon as I exited the trade, it went wild on volume. I couldn't anticipate that. So I'm going to be back in about 35 to 40 minutes. We'll make it about 1:20, because right now crude is as dead as a doornail. And if it stays that way, we're just not going to trade it. I don't want to risk anything. I'd rather come back in the morning tomorrow and see if we can get early trades on get out. Tomorrow's options expiration. So it's going to be a very choppy market. There may be more volume because of options expiration, but we have to be very, very careful with how we trade on that day. I don't want to give back any money tomorrow. I want to take very conservative trend trades with background bias in our direction and leverage the multi-time frame analysis. That's going to create for us multiple wins. So I'll be back at about 20 after 1. Let's see if crude doesn't pick up. If it doesn't, we're just going to stand down for the day. So I'll see everybody in about 35 minutes. Bye-bye.